Bowley, Chief Market Strategist here at EarningsBeats. Hey, good morning, everybody, and welcome to this Tuesday, January 21st, 2025 edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats. Pleasure to have all of you with us this morning. Going to be a little bit of a different show today. There was no market yesterday. We were closed for Martin Luther King's birthday. So as a result, stock market was closed. We don't really have a whole lot to go over as far as action from yesterday. So I thought what we would do today, it kind of coincides with what we call our model ETF portfolio draft. So every 3 months, we draft some ETFs, usually somewhere in the neighborhood of maybe 6 or 7 up to about 10 ETFs that we use to track for the next quarter in an attempt to try to outperform the S&P 500. And we've had some success in doing it. It's not nearly as successful as our individual stock portfolios, but when you think about it, trying to put together a portfolio of ETFs is really difficult because you get so diversified. Instead of moving into individual stocks, you're moving into baskets of individual stocks. And we're not picking the baskets. We're not picking the stock. Well, we are picking the baskets, but we're not picking the stocks. So if you get an ETF that you really like, but it's got 100 stocks in it, it's going to be really hard. It's going to be more diversified, and it's more difficult to try to outperform with more and more diversification. So by the time you get 6, 7, 8, 9 ETFs in one portfolio, you can be extremely diversified and very difficult. Again, it becomes very difficult to try to outperform the S&P 500, especially when the S&P 500 is a market cap weighted index that features a lot of the Mag 7 stocks. I mean, those Mag 7 stocks make up a big percentage of the S&P 500. So trying to find baskets of stocks to outperform the major indexes is difficult for sure. But there are a lot of folks that do like to trade and invest in ETFs. And so what we do is we try to look at the themes that exist at the time of our draft of these ETFs, and then also try to think about what we might encounter in the near term over the next couple of months, because again, in 3 months, we'll do it all over again. So it's trying to take advantage of some short-term momentum in the market and some various themes to try to outperform the S&P 500. That's the whole idea. So I'm going to get into that in 1 minute. Before I get into that, I do just want to point out, well, let's go over, take a look at it real quick. I'll show you. If you go over to stockcharts.com on the dashboard and you hit this drop-down menu over here, pull up symbol summary. And then what I do just to check futures is literally just pull up the ETFs that track the major indices. So for instance, the DIA tracking the Dow Jones Industrial Average. Currently this morning, you can see right here in the middle, kind of middle of your screen, pre-market 436.73. That's up $2.01 or almost 0.5%. We do the same thing for the Spider, which tracks the S&P 500. And you can see right here, up 0.53%. Do the same thing with the QQQ, and we've got 0.6%, and then finally small cap IWM, and that's up almost 0.75%. So leading today as we move. This is the first trading day actually after President Trump's inauguration yesterday. So market getting off to a pretty good start, at least in pre-market action. We'll see whether that continues throughout the day. But yeah, I mean, we got a little bit of strength in the small caps, which I'm hoping continues throughout the quarter. I really still think fundamentally and even some technical reasons still point to me to the IWM outperforming as we go forward over the next few months. But that remains to be seen. We'll see. But I just wanted to point out where we were in futures before we get this thing started. So when I look at the market, again, when I'm thinking about going into whether it's stocks, whether it's ETFs, whatever, I try to keep in mind the big picture of the market, number one. Are we in a bull market or are we in a bear market? Well, we're sitting right up near all-time highs. So it's really hard to argue that we've started a bear market, a secular bear market, or a cyclical bear market. At this point, I would say the odds are certainly with the bulls. So the first thing I'm going to think about is that, we're in a bull market. And so I'm not thinking about cash. I'm not thinking about shorting for sure. I'm trying to think about putting together a portfolio to benefit from the market moving higher. Now, next thing I guess would be, is the market cautious? Are we just runaway? Is it a runaway train bull market kind of a thing? What are the underlying signals saying? All of those types of things come into play in determining what types of ETFs I want to put into the portfolio. So in other words, if I'm really bullish the market, or I think that we're going to go higher over the next few months, then I'm probably going to want to try to put a little bit of a spin on the portfolio so that maybe we're overweight a bit toward aggressive areas of the market. It could be something even like the QQQ, which I pulled up this chart here, QQQ relative to the spider, so that you can see over the last 12 years, since this secular bull market was confirmed back in 2013, this is how the QQQ has performed relative to the spider. Now, again, keep in mind the idea with these portfolios is we want to try to beat the S&P 500. Well, one way to do it in a secular bull market is simply to own the QQQ, because historically the QQQ outperforms. Now, we did have a cyclical bear market in 2022, and you can see during that period, the QQQ, which is much more technology laden, struggled. During a cyclical bear market, you're going to have a lot of growth stocks that go out of favor. Many are going to tumble. And as a result, you're going to see more growth oriented indices or sectors or ETFs struggle on a relative basis. That's what we saw in 2022. But throughout much of the secular bull market, if you wanted to outperform the spider, one investment that's been great has been the QQQ. So that's one theme I have going in. I mean, I kind of see, we topped in the QQQ versus the spider back in 2020, which kind of made sense because we had this nice steady outperformance going in the QQQ. And then after the pandemic, we had this massive outperformance during 2020 in the QQQ versus the spider. Growth stocks absolutely exploded. So we've gone through now 4 years of sideways consolidation. Now, there's been ups and downs, but essentially we're sitting on a relative basis right where we were 4 years ago. And so that tells me that, we've got a pretty decent chance that we're going to move higher. Now, I'm of the belief, and, it all depends on, some of the things you believe in. I'm of the belief interest rates are going to come down, short-term interest rates, Fed funds rate, which is going to spur economic activity. So if economic activity is spurred, the market starts to anticipate that, the stock market's going to be looking more at growth than value. So right off the bat, the QQQ kind of makes sense to me because it's kind of gotten now back onto that trajectory that we had back in the 2013 to 2019 timeframe, where the QQQ was just consistently outperforming. Then after this huge move up, huge move down, back up and sideways, I kind of feel like we're now just kind of back into that channel. So that's going to be theme number one for me, is that I do still believe that there's a good chance that the QQQ outperforms. Now, there are other areas, and I'll show you how I come up with a strong earnings chart, or excuse me, the strong ETF chart list here in just a minute or so. But after I ran a scan and I came up with the ETFs that I wanted to consider for this upcoming quarter, one of the ETFs that was on there was this IHI, which was medical devices. And after mostly sideways consolidating, we did make a pretty big push to the upside. Now, the healthcare ETF, the XLV, has been underperforming. But on its absolute chart, it's actually really close to a price support level where I think healthcare could actually do pretty well here over the next few quarters. And so what I wanted to pull up here was looking at the IHI relative to healthcare, the XLV. And then we'll pull that up with a solid thick line. And put the height at 1 so you can get a good sense of what's going on here. So here's the medical device group breaking out above the prior high at the beginning of December. And December was a rough month for the IHI, the medical device ETF, just like it was a rough month for a lot of areas of value, more interest rate sensitive areas of the market pulled back. That's not exactly what medical devices is, but it's part of that value group that struggled in December, but has come back to life here in January. But not only has it come back to life, we've made a pretty big breakout here above this 61 level. And I love this relative strength within the healthcare area. And the reason I say that is that if the healthcare area starts to move to the upside and we're in one of the leading areas of healthcare, then I'm expecting that we're going to get that outperformance versus the S&P 500. So this is one of the areas that I'm hoping maybe will give us a little bit of a boost, because what we try to do at EarningsBeats is try to find a couple of themes that gives us a little bit of a leg up. In other words, where can we overweight ourselves a little bit so that if we're right about that theme, it helps us to outperform the S&P 500. That's what we're really trying to do. And so I think IHI is one of those areas of the market. Now that it's uptrending, it's made a breakout. It's showing great relative strength within its sector. And its sector, on an absolute basis, is down near support. I've talked about this for the past few months. The XLV sitting, maybe just a couple of dollars right now above key support. In fact, I can pull that up and show you. So the XLV, if you look at it, it's been downtrending, has not been good. It's probably been the worst or one of the worst areas of the market over the last 4 or 5 months. But if we take this and we look at it over a longer term period, let's go back 5 years. You'll see that healthcare went sideways for a couple of years after the XLV got up to about 136, 137. That's what these tops were here in the middle coming across. And then we went through these tops at the beginning of 2024. And notice on any pullbacks, where have we gone? Right back to maybe 135 here, 137 here, 135 here. So this is a key area of support, 135. So if healthcare continues to hold on to this area, and then it just does what it normally does, which after a period of weakness starts to pick back up again, which I think it could do now, this is an area that if it bounces back and we're in a strong area, kind of makes sense, for how this could help us outperform in the upcoming quarter. So that was, just showing you some medical device information. The other thing is I really like the setup in the internet group. You got the internet index here, which has been going up. We've gone sideways, but we got you could call this an uptrend, like a flagpole with a flag after it, where we're trying to break out above about the 5,200 to 5,250 area. Got close on Friday, maybe with futures up. Maybe we get that breakout we're looking for today on internet. But this is a group that really looks strong to me. It looks poised for additional strength in the weeks ahead. And so if I'm right about that, I think this group outperforms the S&P 500 and again gives us a little bit of a leg up. That's what the hope is in putting together these portfolios. And when you put together these portfolios, whenever I talk about ETFs, I always say you got to know what you own. A lot of people don't realize when they get into an ETF, somebody's told them about an ETF or something, that it's less risky because it's diversified and, oh, this one's been going up really nice. And so folks will jump into it, put thousands and thousands and thousands of dollars into it. And they don't even know what they own. They just think that it's this thing that's just going to keep going up. So anytime we talk about this model ETF portfolio, one of the first things I'm going to say is you got to know what you own. And I'm going to show you our ETF analyzer spreadsheet in just a couple of minutes, which helps me to understand what I own when I get into various ETFs. And I'll show you exactly what I mean about that in just a couple minutes. But first, here's the internet group, which I think looks like it's, we had a nice uptrend. We had a little handle come back. We've broken out. We've got a bullish pattern here waiting for yet another breakout. So this is a group that I want to make sure that I've got some weight in when I put together the portfolio. So let me talk about one more area, because I wrote about this over the weekend. In fact, let me just show you the article. Right here, one group has shown consistent relative strength for the past year. And by the way, if you come over to Stock Charts and you want to find some of my articles, the best way to find them is just go into this drop-down menu and go down to my blog, Trading Places with Tom Bowley. If you click on that, it'll bring up all the articles I've written in chronological order going back. Usually try to write a couple a week, at least one a week. Sometimes if I do some vacations or something, it might be a couple weeks, but usually it's at least one article a week, sometimes a couple. But when you go in, I want to show you this one because I talked about banks. But first thing I'll show you is once you get in, make sure you know that over here you can follow the blog by simply putting in your email address and submitting that. You become a subscriber of my blog. There's no cost, no credit card. Stock Charts has said they don't use these email addresses for anything other than the stated purpose, which is to get these articles. So they're not going to be selling your information to third parties, anything like that. So very simple. Email, hit that submit button. And then when I publish these articles, since they're not exactly
Hello, good morning, everybody. Tom's having some issues right now. He'll be back in like 5 minutes. So if you'll stick around and wait, he'll be right back. Sorry for the inconvenience.
Okay, I'm back. I think am I set to go live?
Yeah, you're back on the screen there,
Okay.
Tom.
All right, let me get my screen set up again so that get back in here. Yeah, power just surged here. It is absolutely freezing on the East Coast. And I think we had a little power outage for a second. The power did actually come back on, so that's good. But let me get this thing set up for everyone where we were. All right. So Tyler, are we back on the Stock Charts article page here?
Yep, you're back on that.
All right. Just want to make sure we're good to go. Okay. So, I wanted to talk a little bit about the banks, just make sure that everyone understands what's going on, not just with the chart of the banks, but what's going on fundamentally and why things are happening the way they are. So I wrote about the banks, and of course, I started with their earnings last week, and JP Morgan absolutely blew the number, it just blew the cover off the ball in terms of their earnings per share. $4.81. They were expected to come in at 403. Now, if you followed banks for a long time, for the most part, banks come in a couple pennies above estimates. That's a pretty decent quarter. To beat the estimates by 20%, it's pretty special. And it actually was much better than all the other banks. But the top 12 banks that I looked at that reported earnings after Wednesday of last week, that's kind of when earnings season kicked off, every single one of them beat, every bank. Now, I think there were some smaller banks I looked at that didn't beat, but for the most part, banks were coming in with some really solid results. PNC Financial beat 377 versus 330. I mean, these are some big beats. Citigroup, 134 versus 125. So what we're going to see with a lot of these banks is estimates being revised higher, multiples are going to expand, and these stocks are poised to go higher. Now, I think the biggest impact is going to be as rates continue to come down and the 10-year Treasury yield still remaining high. I don't think we're going up much from where we are on the 10-year. I don't believe we go through 5%. I'd be surprised. We've already started to reverse back down. I don't know where we are today, but I think 4.50 to 4.60, somewhere in that range last time I saw. But with the 10-year, the long-term yield remaining higher and the short term coming down, it's uninverting the inverted yield curve that we had. And it's starting, and as that uninverts and the spread starts to widen, that does nothing but literally just drop money into the bank's coffers. And so I've said for a year, I thought the banks, this was a great area to be invested in. And I continue to think banks will continue to do well, despite what everyone keeps talking about. A lot of folks still, convinced that inflation's, going to come back and all, and rates are going to take off, and the Fed should be raising the Fed funds instead of lowering it. To me, it's all noise. The charts do not tell me any of that. The charts are telling me the rates are going to come down, the short-term rates, and that's going to benefit the smaller and mid-sized banks, in my opinion, just as much, if not more, than the big banks in time. The other thing you have to understand about banks, because we got a lot of tailwinds for this group. The other thing is President Trump's talked about a lot of deregulation, and there's no group that's been more heavily regulated than the banks. And so if we talk about deregulation and allowing these banks to focus more on their profits and managing their business rather than all the regulations, that's another tailwind for this group. So I see the combination of the fundamentals with interest rates lining up, short-term coming down, long-term remaining elevated, but not high. That combined with deregulation, I think is really setting up this group, the banks, to do well. So this is an area that I want to have some extra investment in. So I just want to go through a few of these themes with you and just give you a sense of what, just some of the fundamental things that we look at. But before I show you the Excel spreadsheet, I do want to show you I wanted to show you the scan that I ran for the ETFs. So, I mean, there's usually some variation off of this scan, but I have an ETF scan for the strong ETF chart list. We keep chart lists, which are essentially watch lists, for a number of different reasons. This one, the strong ETF chart list, we do once a quarter. We update it right before the draft to look to see what are some of the strongest areas of the market, momentum-wise, and then start to dig into some of those ETFs to figure out which ETFs we want to include for our portfolio for the next quarter. So what I do is I start off with, I want the volume of the ETF to be somewhat liquid. If you get a really illiquid ETF, many times the bid and the ask are all over the place. You can get a really wide bid and ask. You could be down 1 or 1.5% just by getting in. and then you got to make that up, throughout the quarter. So I really want to try to get mostly liquid ETFs. The ETF is just a basket of stocks. So the ETF is going to end up going in the direction of whatever the stocks that basket owns. It's going to go in that direction. But getting in and getting out, I mean, if you lose 1 or 1.5% on the in and on the out, and you're only holding it 3 months, that's 2 or 3 percentage points you're giving away off the bat. So I want to make sure it's liquid. Whatever that number is to you, it is. But I would just, if you look to buy an ETF, just look at the bid and the ask, and just make sure that you're not, losing out too much at the very beginning. Also, I want to get rid of the ultra and the inverse ETFs. I mean, that's not really anything we're interested in putting into one of these portfolios. We get rid of that. We want U.S. stocks. So we do the country as U.S. The PPO line, this tells us a little bit about momentum. We just want to make sure it's positive. Now, sometime if the market was going absolutely crazy to the upside, and let's say the S&P 500's PPO is at 2 or 3, then probably we'd want to raise this PPO, because otherwise we'd be bringing in every single ETF that's out there. But by using greater than 0, it's going to limit us to the ones that are at least showing some strength on their chart. Also, among ETFs, we want to make sure the scooter is at least 80. So then what I do is I run this scan, and it comes up, it's got 89 stocks on it, or 89 ETFs. And then I'll start going through and just looking for stuff that I don't want. Option income strategy, not really interested in that. This, even though it's a US fund, it's focused on Argentina. We're not international experts. We don't want international funds. What we're doing with our portfolios at EarningsBeats is following the things that we consider ourselves to be experts in, which are US stocks, not foreign stocks. So Argentina is out. Bitcoin, that's a separate asset class. Cryptocurrency is on fire, and that's great. That's not what we do. We do stocks. So going to get rid of a lot. There were a number of Bitcoin. Anyway, by the time I went through here and got rid of a lot of the areas of the market that we just simply are not going to invest in, this was actually down to about probably 65 out of 89. And then once we start going through stocks, I start finding that, maybe the stocks themselves are unlisted, or they're on some foreign exchange and I can't get, much about them. I can't find ticker symbols where we can track them. I started eliminating those kinds of ETFs. Anyway, the whole group ended up coming down to 60 stocks, or 60 ETFs. So if I go in here, I will show you our strong ETF chart list, and we'll view all. Market's getting ready to open, but I'll probably end up going a few minutes in because of the issues we had with that power outage a little bit earlier. But here are the ETFs, and actually, well, let's just do it by name. So I ended up getting down probably to about 50 ETFs, and then I manually add some, and I'll explain why I do that. So what you'll see is, as you scroll down, I put all the sector ETFs in. Now, if we add in here the scooter score, most of these you see are going to be over 80, but there were some that weren't over 80, like materials. That's one of the 11 sectors. ETFs, or the scooter score, is only 24 out of 100. So it doesn't show much relative strength. It's actually very weak in terms of relative strength. Then you come down here, technology is only 58. Consumer staples is 9. So, but I do this every quarter. I want to make sure that if I get to the end of doing what I'm doing and I still need to find, say, another 5%, let's say my goal is to have 10% more in technology than the S&P 500 does. And I get to the end of all my picking of ETFs and I realize that technology is equal in the portfolio versus the S&P, and I want to get another quick 10%, I could just come in and put 10% on the XLK. That's 100% technology stocks. And so that would give me my additional 10%. So I like to use these sector ETFs just to have an opportunity to kind of balance out what I'm going to show you on the strong ETF or on the ETF analyzer here in just a minute or two. Anyway, all of these are added. I love the small caps and the mid caps. If you look, the small cap did not come up on this scan because it's only at 73. And I like this small cap momentum ETF more than I like the small cap Russell 2000, the IWM. So normally I would add the IWM. Instead, I added this one. Mid caps, this one already came in with its scooter score above 90. What else did I add? Oh, I added the QQQ. This one, I don't know why I had to add because the scooter's at 81. Must not have met one of those other criteria. I don't know which one it wouldn't have met. Let's pull it up. Yeah, the PPO is just barely above 0 because I thought maybe that was it. Anyway, the QQQ, I want to make sure I have it in there so that I can invest directly into that if I want. It also, QQQ has a high weighting in some of the stocks that have a high weighting in the S&P 500, like the Mag 7 stocks. Actually, it has even higher weighting in the Mag 7. So if I want to kind of get some representation in there to keep up with the S&P 500 or to beat it, I got to have some of those stocks that provide us with the potentially big returns like the Mag 7 has over the past few years, several years. Okay, so with that, I'm going to go ahead and go into the ETF analyzer and kind of show you what we do there. So bear with me. Going to need to get over here. Actually, let me go. Gonna have to stop the screen for just 1 second. All right, and now let me go back over. Get the Excel spreadsheet. All right. Okay, you should now have this ETF analyzer on your screen. Let me just make it a little bit bigger here so kind of see this a little bit better, hopefully. So what I do first of all is I just drop once I come up with a strong earnings chart list, or excuse me, strong ETF chart list, I then go in and I put all of these ETFs in this spreadsheet. So I have the ticker, the name of the ETF, the allocation percentage. So this is kind of what I'm going to use. Uh-oh, I don't know what just happened here. Hopefully you still got this screen up, Tyler, if you're there.
Just yeah, the screen's still up.
Okay, thank you. So then I'm going to have this allocation percentage where I'm going to decide, okay, I want to put 10% in this ETF, or I want to put 20%. So that would look something like this. Let's just say I want to put 10% here, and I want to put 15% in this one, and I'm going to put 25% in this one. I'm going to put 5% in this one, and 10% in this one. Anyway, I'm going to keep doing this until you see this error. Right now, I've only put 65%. So let's just say to finish it, I'm just going to put 35% in here. So once you put in enough percentage in this allocation percentage column, then you have no error because now everything adds to 100. So we have a little audit feature in here just to make sure that your total allocation equals 100%. Now, the next column here is the top 10 holdings. And so for, let's look at ARK Innovation, one of Kathy Wood's funds. So here, ARK Innovation, 64.8% is invested in their top 10 stocks. So it's telling us that that's a pretty concentrated ETF. You know, you got one down here, this Aventis US large cap value, where the top 10 stocks are only 25%. So this one's going to be much more diversified, 25% versus 64%. Now this top 10, there's a top 10 tab here at the bottom. So this is ETF number 3, ARK Innovation. If I go to the top 10 holdings tab, number 3, this is ARK Innovation. Here's that 64.8, and it gives you the 10 stocks that are the highest weighted in that ETF. So now when we start talking about know what you own, this is how you know what you own. If you decide to put money, 10% or whatever, into this ETF, then you can pull up and see that Tesla, if you've got 10% in Tesla and Tesla's got 15% in this particular ETF, then multiply the two together and you've got about 1.6% of your entire portfolio that's going to be going into Tesla as a result of this investment in the ARK. So then you got Roku, Coin, Roblox. Anyway, you can see the stocks and you can decide, okay, do I like the stocks that are being heavily represented and heavily weighted in these ETFs? And if you say no, if you look at it in the top 2 or 3, you don't really like, probably don't want to invest in that ETF. Find others where you have higher concentration in stocks that you like. So again, that's just the next column, the number of holdings. So with the 64.8%, the top 10, there's only 34 stocks in the entire ETF. So outside that top 10, you only have 24 more stocks. Here, with this large cap value, top 10 are 25%, and then you still have another 290 stocks. This ETF, it's going to be really hard for this ETF to outperform the S&P 500 over time because it has so many stocks in it. And if the Mag 7 are going higher and this is weighted less toward Mag 7, which we could go to number 6. Let's see what here it is, AVLV, there's the 25%. Apple's a top holding, but it's only 3.96%. The Spider, the holding in Apple, is much, much higher. And so, Microsoft's not even in the top 10. NVIDIA, not in the top 10. So if those stocks do well and lifts the S&P 500, this ETF with its 300 stocks has almost no chance to outperform unless the value stocks are leading the market to the upside or simply going down less to the downside. So this is probably, if you believe in growth and you think the market's going higher, this is probably an area of the market that you don't want to be invested in because it's going to be more geared toward value. And over the last 12 years during this secular bull market, value has trailed growth by a wide margin. So if that continues, then you really don't want to be in there. Now, we have had some periods where value has done well over the past few months. And remember, scooter scores only look back. That's one of their limitations. They're only looking back at what's happened over the last 5 months. And for a while there, value was doing pretty well, making a comeback. And that's why AVLV is on this list to begin with. But it's not really what I'm looking for. So let me, and then let's just keep going across. So each ETF, once, let's say ARK Innovation, after I've, done the top 10, I will then look to see which industry groups are represented in this particular ETF. Well, ARK Innovation, 18% is technology, 19% is discretionary, 20% is communication services, 18% is financials, and 20% is healthcare. So you've got a lot of it right there in those 5 groups. Very little bit in industrials, but look, nothing in staples, nothing in real estate, nothing in utilities, nothing in energy, nothing in materials. So if you put money into ARK Innovation, you're going almost exclusively with growth and almost nothing with value. Maybe some financial stocks, maybe a couple of, technology stocks could be considered value, but for the most part, you're getting into growth. And so the whole idea is to take all of this into consideration. And when you put it all together, know what these percentages are. Here's the S&P 500 right now, at least based on the research over at Fidelity that I did. This is what the allocations are on the S&P 500. Now, it actually might be just a little bit off from Fidelity because when I put all the percentages in and I came across this was not 100%. It was like 99.30 or 99.50 or something. So what I ended up having to do is just go back in and prorate a little bit to make these a little higher so that I could get it to 100%. But this is essentially the breakdown in the S&P 500 right now. Now, with what I just randomly threw in there, I've got 100% invested, but look how it comes out. With the stocks, these are my results. So once I get to 100%, this is telling me how I have my money invested. So you can't say you don't know what you own. You own 3% of technology, 2% of discretionary, 3% of communication services, 5% of industrials, 62% of financials. I hope you love financials. So it's not just you go and you buy a bunch of ETFs. That doesn't mean you're well diversified. You need to understand what these ETFs own. And that's why we have this ETF analyzer. So what we end up doing is once we get through here, we want to make sure that we have essentially what we want in terms of all these various industry groups. So what I'll normally do is I'll go in and I'll say, okay, for the upcoming quarter, I'm okay with, just going along with the S&P 500 on some of these. And this is kind of what I did, by the way. I was okay kind of going across the board. I got the financials. I still like the financials. I think I ended up going up a few percent on the financials. And then the others, I just kind of came down a little bit on to kind of make up that difference. So these were the percentages, but then I'm going to try and zero in on some specific areas like medical device, like banks, like internet. And I'm going to try to outperform by hitting a couple of key areas that I think are going to outperform. Now, if I'm wrong and those groups underperform, then guess what? The model ETF portfolio is probably going to underperform. That's what happens when you pick themes and you start putting these things together the way you want. Well, maybe things don't turn out the way you initially believed they would. And so that can be a problem with this. Now, last night I sent out to our EarningsBeats members an email, and I told everyone what the percentages were that we were going to put into each one of these ETFs for the next quarter. You should have gotten that email. If you haven't, check your email. And if you still don't see it, then reach out to us at support@earningsbeats.com. We'll make sure that we get back to you and get that information to you. But I just wanted to kind of show you how, we go about things. The top holdings, in other words, like when I looked at, what was it? IHI. So that was medical devices. Here are the top 3 holdings: ABT, ISRG, and BSX. And they make up, what's that? Probably 32.5%. 43% of IHI are these 3 stocks. So you better like these 3 stocks. Well, I pulled them up. ABT was okay. It had pulled back. It wasn't a leader, but it was coming off support, recent support. So you could look at that chart and you probably see it's right near or at a price support. ISRG and BSX have both been absolutely exploding to the upside. They've been leading. ISRG just recently came out and provided preliminary results showing that they were beating top and bottom line. They're going to actually report their results this week. BSX has been one of the best medical device companies out there. And we've got 11% invested there. So anyway, I've got one stock at major support. I got another stock that's already preliminarily reported great results. And then probably one of the best stocks in terms of momentum within this group in BSX. That's 43%. So in this case, I am kind of controlling the stocks. It's not just an ETF that, has all these, all this diversification. I'm targeting IHI because it's got 3 stocks I like that are 43, 44%, probably about 43% of the entire portfolio. And the top 10 here, which there are several others I liked on this list, top 10 are 74%. So they're concentrated. So I'm getting money to go exactly where I want to in this model ETF portfolio. It's just a small piece. I'm not going to give out percentages. I'm going to leave that for our members. But that's the way we approach this. And then when you take a look at the banks, you can see we have 3 of them on here, 3 different areas of banking. The larger banks where you've got JP Morgan, Morgan Stanley, Goldman Sachs. It's a little bit more, it's got investment services in there as well. Then you've got another, which is much more much more diversified, where you have more mid-sized banks. Don't really see the big names on here, but that's only 29%, the top 10, meaning that it's a very widely diversified banking ETF. And then you've got the regional banks, which is going to include more small and mid-sized banks. A little bit heavier concentration than the KBWR. But if I like banks, which I do, and I like financials, here I can pull up 3 different ETFs and decide based on their holdings, their concentration, which one I'm more comfortable owning. Do I want the large cap? Do I want the small cap? Or I should say smaller cap. That's Truist. That's not a small cap bank. But, exactly what do I want? And so that's the process we go through in putting together these portfolios. So anyhow, that's about it for today. Let me just give you a quick look at the market. So let me go back over here and we'll present just a quick look at the market. Well, I can't find my other screen. Well, how about if I just tell you what is going on with the market? So yeah, right now we've got the Dow up 328 points. That's 0.75%. S&P up 32. That's over 0.5%. NASDAQ coming down a little bit. It's up, but it's only up 0.1%. Small caps are up over 1%. So we're seeing that leadership in small caps today, at least to start out. But this is a big move. I will say that the IWM is above 227, actually almost 228. So it looks like it's making that big move to the upside. It's up 1.11%. I'm actually looking for a move here to the upside in these small caps. So we'll see how it goes as we move throughout the balance of January. And then, of course, there's the January effect. How does the market do throughout the entire month of January? That'll set us up for maybe how we're going to do the rest of the year. I'll be talking about that much, much more as we get toward the end of January and into the early part of February. But that's it for me. I hope you enjoyed this session. Just a little bit different look at one of the things we do for our members at EarningsBeats, which is take a look at these strong ETFs, put together a chart list, which we can then have members download directly into their Stock Charts account if they are Stock Charts members. Stock Charts and the EarningsBeats, we have no financial ties. We're not related in any way. I just use their platform, and I know a lot of the folks over there, and I really like the folks. I like the platform, been using it a long time, and so we use it in our service. So if you want, you don't have to be a Stock Charts member, but it's certainly, if you like the information we provide and you want to work off of our research, then having a Stock Charts membership makes a lot of sense. Because if you're on their platform and we're on their platform, I can literally just give you chart lists and you can click on one button and download it into your Stock Charts account. You do need to be at least an extra member at Stock Charts, I believe, because I think basic members only get one chart list. That's by default. They assign it to you. You can't download any of ours. But if you're an extra member or a pro member, I think at extra you can do like 250 chart lists. And we only have about 20 or 25 at any given point in time. So you can download all of our chart lists into your account, all of our watch lists, and I think it will make for a much better trading experience for you. Anyhow, that's it though. Have a great day, everybody, and I'll be back on Thursday over at Stock Charts for the next video. And of course, I'll be back with our weekly market report to our members later today. Have a great day, everybody. Happy trading.